All right, welcome back to Power Lunch. We're going to stick with the tech trade and bring in Ed Yardeni of Yardeni Research. Ed, we want to kind of take a look back at some of these historical tech valuations. Overall,
Sure.
There's been a case made by more than a handful of strategists and traders out there that when we talk about valuations in the current market, that it is not fair to compare them to what we've seen historically over the past 20, 30, 40, 50 years, because the entire paradigm has changed. It is now a higher ceiling and a higher floor for valuations. Is that an argument that you buy into and believe?
Well, it's the traditional, this time is different argument, I suppose, and that more often than not doesn't work. But look, the reality is that we're looking at the S&P 500 PE, forward PE, now suddenly a bit below 30. And back during 1999, the tech bubble, the multiples for that sector was 50. So we're really not in the kind of bubble territory we had seen back in 1999. And then, of course, some of the arguments being made at this time is different are relevant. There's certainly less seller financing than there was back in 1999 when telecommunications companies did a lot of that, and it turned out to blow up in their faces. Also, a lot of companies were spending on technology in 1999, trying to upgrade their equipment so that it would work at the turn of the millennium. These are not issues today, of course, but the circular financing is, I guess, one of the concerns today. The quality of earnings is one of the concerns today. Last week, I actually recommended underweighting the Magnificent Seven because I felt that they're starting to compete against each other pretty aggressively, and so as a result, I said, maybe move into some other areas of tech, but also continue to overweight financials and industrials.
What was the term, Kelly? Right? Wasn't it the impressive 493, or I forget what the term?
Yeah.
Yeah. So you said to kind of move towards there, but from that valuations perspective, then can you compare other parts of the market that are not the Magnificent Seven to those historical averages more closely than you can with these mega cap tech stocks? Or are they just in a league of their own, and do you have to value them differently than the impressive 493?
Yeah, I don't want to go into this time it's different story. I don't think it's going to be that radically different in terms of valuation. Valuation is high whenever growth expectations are high. In 1999, I don't recall too many, if any, people really saying we were in a tech bubble, that we were in a dot-com bubble. It just kind of all of a sudden blew up, and then benefit of hindsight, everybody said, oh yeah, we were in a bubble. This time around, there's nothing but questions all the time about whether we're in a bubble. And I think the answer is already in front of us. Yes, we're in a bubble, and the bubble's losing air. It's not bursting, it's losing air. Valuation multiples are coming down. Why? Because there's a recognition that AI has caused the Magnificent Seven to compete with each other. Dom, the analogy I use is the Game of Thrones. In the opening credits, the towers kind of go up and down. Basically, we've had seven kingdoms here in the Magnificent Seven. They've had big moats around them, and they've operated kind of independently without bothering each other. Now with AI, suddenly they're competing with each other, and competition tends to bring margins down.
Ed, why do you think, or do you think that this is the year that the party ends, or 2026? While there are many out there who still expect that the AI bubble has several years left before we get to the really kind of top-off phase?
Well, I think because there's every sign that people are coming around to viewing the Magnificent Seven as maybe a little less magnificent and starting to focus on the impressive 493 or maybe SMID caps. We're seeing, obviously, small cap stocks doing quite well with the Russell 2000 at a record high. But I think what's changed for me over the past several weeks is I think Michael Burry kind of suddenly made us realize that there really are a lot of uncertainties with regards to the future growth rate of these Magnificent Seven companies that are now competing in this AI race. And in addition, we know that there's a lot of question marks about whether all this capital spending is going to pay off in a decent return. So suddenly there's a lot of uncertainty about the projections for strong growth in these seven companies. And I think the market's still in a bull market. People still want to be in the market. But I think you're going to see some lightening up, as we already are over the past several days in the Magnificent Seven. And I think more money goes into financials, industrials. Financials have done well. And I think even healthcare. I haven't been recommending healthcare as an overweight, but I am now.